Perhaps the most notable trend in the U.S. housing market this year has been the pace that would-be home sellers are withdrawing their listings. Early in the year, we had good growth in the new listings rate, which with more sellers showing up each week. But as mortgage rates stayed higher for longer than expected, home buyer demand waned. The first half of the year had fewer transactions than even the very low 2024. Home sellers who don't get an offer basically have two options. They can drop the price or they can withdraw. We've been tracking the withdrawal rate as a percentage of the new listings. This tells us how many of the new listings in a given period are giving up. New data from Compass shows that through September, withdrawals are happening at a rate of 42.3% of new listings. That's significantly higher than any recent September that we have data for. There might be as many as 200,000 sellers who tried and are now waiting for conditions to improve. I've been discussing withdrawals with agents around the country. Who is withdrawing? What are the conditions that make a seller give up? It turns out that commonly those withdrawing may be looking at a resale price that is below where they bought in the last few years. It's very, very painful to sell at a loss, giving up some of the original down payment or equity. As a seller, you could lower the price and sell the house. But if that means you'll lose money, it's often a compelling option to just walk away. On the other hand, I have a friend who thought it might be time to sell their second home, a lake house. They had no bites in 3 months and just decided that now is not the time. They tested the market. They have plenty of equity and a cheap mortgage, so the holding costs are low. Some withdrawals are short-term. Sellers use withdrawals as a strategy, pull it from the market for 30 or 90 days and then relist at a new price. Some withdrawals are longer. Take it off the market now, maybe to try again next spring. If all these sellers tried to sell this year and were frustrated, does that mean there is a pent-up supply, sometimes called a shadow inventory, out there waiting to slosh onto the market in 2026? What if all 200,000 of those potential sellers showed up on March 1st next year? As I mentioned, in early 2025, the new listings volume was already the highest since the pandemic, anyway. I've been expecting that next spring we'll gradually see more sellers again. My hypothesis is that many potential home sellers have been waiting for years. The longer we go, the more of them are tired of waiting. So new listings would climb again in 2026. But if all these withdrawals show up, will inventory skyrocket? Could a big imbalance in supply and demand create a crash in home prices? This important nuance is the distinction between the two types of withdrawals. Those who are in that first group, who want to move but are underwater, most of those sellers are also buyers. These people are they're not in the right house. So this withdrawal group not only illustrates potential supply, but it also illustrates potential home demand. Most sellers are buyers. The second group is more likely to add to inventory when they finally relist. To the extent that investors, for example, are selling, those would add to inventory. Second homeowners would add to inventory. My suspicion is that this second group is smaller than the first. The key to interpret the implications of today's withdrawal rate is to look at the phenomenon not as just shadow inventory, but as delayed transactions. Those purchases are also being delayed. So in the data today, we'll look at this withdrawal rate, the new listings rate, of course, and inventory. As always, we'll check in on the week's pending transaction pace and the latest pricing signals. I'm Mike Simonsen, I'm the chief economist for Compass. In these videos, I look at the U.S. housing market data every week. Our goal is to help everyone understand what's actually happening in the market right now so they can make the best decisions when buying or selling a home. In these videos, I use data from Altos Research as well as Compass. And if you like these videos and our weekly housing market data, please add yourself to our new Compass Intelligence mailing list. There's a link in the description below to join us. Click that link and add your name to the list. We send the Compass Intelligence email every Monday with the latest data, the slides, and this video. This is a new list we're building from scratch at Compass, but we already have thousands of people who've joined, so you should join us too. Link below. All right, it's already October 2025. Let's look at the latest housing market data. We'll start today with the new listings and then switch to the withdrawal data. New listings ticked down again this week, as you'd expect for October. There were 1.4% fewer home sellers newly on the market than a week ago. 1.4% fewer. We counted 64,000 single-family homes and another 14,000 condos newly listed. The pace of new listings is trending lower, but it's still slightly more sellers each week than in 2024. In this chart, I'm showing a 90-day rolling average of that new listings pace. It shows the declining trend pretty quickly. The recent average is 66,000 newly listed single-family homes each week. The 2025 is the blue line in this chart. Sellers this year started stronger and then faded since July. I think this decline in the pace of new sellers is related to the escalating pace of withdrawals. So both are reactions of potential home sellers deciding it's better to wait than to sell now. 2025 has generally seen more new listings per week than 24, which was more than 23. And as I mentioned, I have been expecting that 2026 will continue this trend and we'll start the year with more new listings. But recently, the downward slope of this new listings line, this blue line here, makes me question that assumption. You'll notice we could duck under last year's seller pace in October. The blue line looks to be heading under the purple line in this chart. If that happens, then we may be setting up for 2026 inventory declines. And wouldn't that be a surprising turn of events? Okay, with that as the backdrop, let's look at the withdrawal rate. How many home sellers who don't see an offer simply choose to take the home off the market? Well, there are indeed a lot of withdrawals now. Through September, that pace moderated a bit from August's peak. We counted a withdrawal rate in September of 42.3%. That's down a touch from 42.4% in August, but is significantly more than the pace a year ago. So we're showing here really a withdrawal ratio. We're looking at the count of withdrawal listings as a percentage of the new listings count. I like this metric to normalize different levels of inventory. There are 500,000 more homes on the market now than a few years ago. So of course there's more withdrawals, but as a percentage of the new listings, it gives us a much clearer picture. So each year of the holidays, withdrawals increase, of course. You can see the seasonal canoe shape of the curve here. This year, though, withdrawals climbed way up in the summer. Since there are the two types of withdrawals, one that will add to inventory when they relist and one that won't, because those sellers are also buyers, this implies that investor-heavy markets and second home markets still have more inventory to build, even as inventory for the country as a whole stays stable. The takeaway for withdrawals is that there are a lot of frustrated sellers now. So it's just that this is not just shadow inventory. It's also an illustration of demand, of delayed purchases. These people are going to try again to purchase in 2026. If we're lucky and conditions improve, if mortgage rates head lower, if the economy doesn't deteriorate, those future transactions would finally lift the sales rate. The weekly pending home sales are a little ahead of 2024. There's no signal of it moving notably higher yet, maybe next year. This week we counted 64,000 single-family homes that went into contract with another 13,000 condos that started that sales process. That pace is down a fraction from last week and is staying about 5% more than last year. 64,000 now versus 61,000 a year ago. In this chart, we have the blue line for 2025 and the purple line for 2024. Each week, it continues to come in just a little ahead of last year. The data I have here is illustrated from Altos. The Compass data also shows roughly the same increases. The sales improvement trend has been pretty consistent, but it's not overwhelming. Not all sources are reporting sales gains. Redfin, for some reason, is reporting pending data that are a little fewer than a year ago. It's hard to know exactly where the difference is. The takeaway for home sales is that, in our estimation, the September existing home sales will likely come in a few percent more than 2024. October had a boost from the lowest mortgage rates post-pandemic. October 24 did. So we'll see how the weekly numbers compare for the rest of the month. Keep our eyes out for that. Withdrawals are way up, new listings are down, sales are up a touch. As a result, the active inventory of unsold homes on the market is not climbing like it has in the fall of the last 3 years. Inventory has stayed roughly unchanged again this week. It's been 12 weeks since inventory stopped climbing. So far, the peak of inventory for 2025 was back on August 1. It's pretty normal, actually, for inventory to reach the seasonal maximum in August. In the last few years, though, inventory climbed all the way into October or November. This year is really a return to normal seasonal patterns. There are now just under 864,000 single-family homes on the market. That's up a tiny fraction from last week. The number of unsold homes on the market has been basically unchanged for 12 weeks. It would not have been uncommon in the last decade for inventory to hit the seasonal peak in July or August. But in the last few years, we've had rising interest rates late in the year. So when rates rise, unsold inventory piles up. So in 22, 23, 24, inventory didn't hit the year's apex until October or November. So in this chart, I have 2025 as the blue line. It's sandwiched in between 2019, the orange line on the top, and last year's purple line below. Notice how by October, the active inventory of 2019 was drying up very quickly, the downslope of the orange line. That time in 2019, mortgage rates had been moving lower all year. It's wild to think you could get a 3.5% mortgage in 2019 before the pandemic hit. The market was heating up rapidly in the fall of 2019. This illustrates why I believe mortgage rates, if they fall from here, say into the fives, I expect that kind of market reaction and inventory to drop. There are 18% more homes on the market now than a year ago. That gap is shrinking every day. I'm watching for how autumn inventory declines in the fourth quarter. Will that set up tighter supply-demand conditions for 2026? It's easy to overlook how much of the country, the markets in the Midwest and Northeast, for example, are still at record lows, basically, for available inventory. I expect those to get some growth next year, but we haven't seen the inflection point yet. So I'll finish today with home prices. There was another small uptick in home prices this week. The median price of the new contracts came in at $398,000. That's up a fraction for the week and is just about 1% higher than last year. In early October last year, though, home prices were experiencing a surprising surge. This seems likely related to the momentarily cheaper mortgage rates, which lifted demand at the time. You can see the purple line here from last year had that lift in Q4. This year, the prevailing price pressures have been down, and I'm a little surprised that we haven't seen this price measure, the weekly pendings price, dip a little quicker. Maybe that's a function of withdrawals, though. So the homes that would have taken the biggest price cuts are not even on the market anymore. If we look at price per square foot, that measure is coming in fractionally lower than last year. The Case-Shiller index for July was just released last week, and it's showing only 1.7% yearly price appreciation. That's declining each month, so by the end of the year, it may show negative too. But if our active supply starts to fall, if sellers are going to hold out for better prices, won't that have upward pressure on this data in 2026? It's hard to imagine rising home prices given the year we've had, but there are some signals in the data that we should watch. Okay, that's all the data we have time for today. If you want to make sure you don't miss any of the weekly data and video commentary, you should sign up for our Compass Intelligence email list. There's a link in the description below to add your name to that list. Thanks, everyone. More next week.